Oh, hello everyone. I hope you're all well. It's Susie again from Esoteric Trading Solutions. I know you've had two YouTubes from me in the last 2 days, and you haven't had one from me from a month. I know I'm a bit inconsistent, but I have to be inspired actually to do a YouTube. I just can't pull them out and do them and talk about garbage. It's got to be something that I'm actually interested in, and it has to capture my imagination. So that's why I tend to do YouTubes. Some a lot, and then other times I don't do anything. If I'm not inspired, I'm not inspired. So that's pretty much the story. Something that caught my attention today, and I found it quite an interesting article, and it's sort of a continuation of the theme that I was talking about yesterday with my last YouTube about fiat markets and cryptocurrency, particularly Bitcoin and XRP. This article does talk about Bitcoin more so as being a global safe haven, but I really believe XRP will be that global safe haven as time goes on. An article in Cointelegraph.com by Horace Hughes, and I thought it was quite a good article, and there's just a couple other things I want to show you as well, which add to this article. I quite liked it actually. It talked about 3 reasons Bitcoin is turning into a global safe haven for investors, and pretty much along the same themes that I was talking about yesterday, where you have Chinese currency devaluation. Obviously, the Chinese devalued their currency against the US to bring it to 7 renminbi from around 5.8 to the US. And then it talks about other fiat currencies devaluing, particularly in line with monetary policy. So clearly, if you reduce interest rates, cash rates, in the very short end, the cash rate being the shortest cash rate of all, the shortest interest rate of all, you're going to actually decrease your currency. In other words, the currency is going to devaluate as well. And it talks about, obviously, the US doing it in other countries, but also it talks about people flocking to gold, cash, bonds, and Bitcoin as a hedge, as well as it should really be talking about XRP, because the behavior of XRP has been fairly similar to Bitcoin. And I think it's quite an interesting article because that's what we're seeing. Gold's gone over US $1,400 or $1,500. It has been holding around for a long time, $1,290. I remember gold in 2001 when it was around 230 US, and I told my brother it was a buy then. So pretty much something's telling us that gold's going up, and generally gold's a hedge for inflation as well. So my question to everyone is, if there's no inflation in the system, then why are people buying gold as a hedge? And I've always been of the mind there is inflation in the system because, our purchasing power of our own dollar, our wages haven't gone up for 20 or 30 years. The middle classes are being squeezed. Our wages have declined over 30 years, and yet the cost of living is certainly going up, and it's not reflected in the inflation numbers at all, as far as I'm concerned. As far as I'm concerned in Australia, that's a fact. The cost of living in Australia has gone astronomical for 20 years. House prices are through the roof. Utilities are through the roof, education's through the roof, even food to some degree is through the roof, travelling is through the roof, health services through the roof, just anything, even registering your cat at the local council, used to be about $15, now it's about $32. I mean, teeth, vet care, anything, I can name so many things that are through the roof. Whether it be utility bills, whether it be electricity, whether it be just anything. The only thing I can say that's gone down are white goods. White goods, obviously, being computer, being the fridges, and they've all come from China. So obviously, buying white goods from China has caused deflation on the white goods side, but it is very specific to which particular area you're looking at. Okay, so me as a consumer, I don't buy a lot of white goods, but I certainly have to have healthcare. I have to, buy food for my animals. I have to buy food for myself. I have to pay for utilities. Electricity bills in the last 20 years have gone up something like 300%. Gas here has gone up more than 300%. Say council rates. We have council rates. I remember 20 years ago, council rates were about $300 a quarter. Now we're looking at about $800 a quarter. So, so many things have gone up, and the cost of living in Australia is just through the roof. And you cannot tell me inflation's not in the system. And yet the Reserve Bank of Australia keeps bringing out with the Australian Bureau of Statistics, the statisticians, that inflation's around 2% and falling. And I just think that is absolute bumpkin. It's garbology, and I don't believe the figures for a minute. because I tell you something, the purchasing power of each of our dollar is not going anywhere these days. That's a fact. And you cannot tell me that inflation is not in the system, because it is. I do not believe the figures that are coming out. And that's another reason why I don't watch TV, because it's all garbology. They're telling all the sheep out there a story, and the story is not true. So a lot of the social media stuff I don't listen to. I don't read a lot of crap in the papers, because they're just basically dumbing us all down like sheep. And so I don't believe the story that we're in a low inflation environment. We're not. As a matter of fact, I believe we're actually in a high inflation environment. It's just that the statistics are not showing it, okay? And that's a fact. Now, given that, yield curves should not be where they are, interest rate yield curves. They've been put there because of central banks' monetary policy, through quantitative easing, through money supply, through reductions in interest rates, constantly reducing interest rates. Yield curves literally have gone, to zero or negative zero. They have played with the market mechanism of risk. Interest rates used to be a market mechanism of risk, right? So in other words, if there was growth in the system, interest rates would rise, thus bringing down, certain things like, say risk assets. And, the central banks have played around with the risk metrics of the market. And now the markets, the capital markets, the global markets, the bond markets don't work anymore. Now, don't forget, I've been in markets since 84, 85, 87, well before a lot of you guys or girls were born. And you know what? The markets do not behave the same way anymore, okay? With all this compliance by, internal compliance for banks and external compliance set down by BAL and, all the central banks and, whether it be Australian Prudential Regulatory Authority for the banks or whatever you want to call it, whether it's been that, banks and, venture capitalists or, hedge funds, they don't trade the markets like they used to. I remember in the olden days, we used to, trade billions of dollars, and the market was volatile and there was so much liquidity, and you had price makers, you had traders in the market trading all sorts of things. I mean, all those prop books, and they call it prop books, where the traders trade money on behalf of the bank or the investment bank. All those prop books and all those traders don't exist anymore. There used to be so many more traders than what there are now. People used to take on risk because they got paid to take on risk. But you know what happened? In 2008, we saw the Federal Reserve, all the central banks globally in the world, basically bail out all the risk takers and all the people at the top of the investment banks and the banks, because they had really, really stuffed up and destroyed, obviously, wealth. And they basically bailed them all out, and the central funding authorities and the central banks became the biggest equity owners in history, with all these equities and mortgage-backed securities on their balance sheets, okay? And the risk managers were still paid billions of dollars in money in terms of salaries, but effectively they were working for the government, because the government supported their stock and everything else, right? And it's very, very contentious. And now the risk managers get paid a fortune, and yet there's no risk taken in markets, and markets suffer with now illiquidity. The liquidity in the markets is not the way it used to be, because there are no risk takers anymore, no prop traders, no speculators, big speculators I'm talking about, taking on the risk of the opposite side. And thus we see a situation where the liquidity in markets is terrible and getting worse. And, this is a scary thing, because when people start selling corporate debt, for example, fund managers, investment banks or whatever, there's no one to sell it to. You know what I'm saying? And that's what I'm talking about. There's no one to take the other side of a trade, and that's the biggest risk I see in these markets. There is no liquidity in these markets, and there's huge amount of debt, and there's no liquidity, and that's scary. And when you've got that situation, markets gap down, and they gap down really fast. Now, everyone assumes that markets can operate efficiently in terms of, all the academic stuff that comes out, which is garbology and crap, but markets in times of chaos do not act efficiently. And I'll give you an example of this. In terms of equity markets, it's exchange traded market. when people are selling, you know, and there's a bid offer spread and people are selling, it's not an orderly market. In other words, the bid offer spread is not, you know, 1901 to 1902. You know, I buy at 02 and I sell at 01. When the market is not orderly and everyone's trying to get out, you know, the bid offer spread could be as wide as $1.50, right? Where it could be, I sell at $17.50, you know, I buy at $19. You know what I'm saying? And that's a gapping down in the market, even in exchange traded markets. Now, the over-the-counter market will be even worse than that, okay? In times when markets are imploding and going down, and they go down quicker than they go up. There was an old saying in markets, you know, down the lift, up the stairs, basically. You know what I'm saying? Up the stairs and down the lift. And markets, when they fall quicker than when they go up. And I just think this is a bit of a scary market. So coming back to this article, there's a former Goldman Sachs executive makes a case why the world is fast approaching a currency crisis. He talks about this. And he said in his 30 years of career, which is pretty much the same as me, he's never seen a market like it, never seen an FX market like it. The dollar appears at a risk of an uncontrolled rise. Potentially, we have seen it go down, but it is rising against all the emerging market currencies, okay? And that's the problem, and all the Asian currencies, which is not great, okay? So every other country that's weaker than the US, the currency is going down and being devalued, which is really, really scary, okay? This fellow said he's never seen markets so scary. So I'm just going to turn this heater off. It's really, really hot. And Melbourne's pretty cold at the moment. It's about 8 degrees. And you know, it is pretty scary. He said the Federal Broad Trade Weighted Dollar Index is literally on the verge of breaking above a massive cup and handle pattern at 130. And as you can see, this is fairly high. Now, this is US index compared to all the other currencies against the trade weighted index. In other words, the export currencies and the import currencies that US trades with, okay? And it basically shows the US is stronger than it's ever been before, going back to 1995, okay? Way up here, it was fairly strong, low, and now it's still strong and looks like it's going to break out to an all-time high, which is basically US dollar strength against all the other currencies that it trades with, okay? And there'll be a group of currencies, you know, it could be up to 20 different currencies that the US will trade with. Obviously, the Chinese renminbi being in that currency as well, which we saw the Chinese renminbi, or the yuan, as you want to call it. There's two different currencies, but they're still Chinese, devalued quite dramatically the other day to offset trade tariffs that Trump's putting in play, okay? So look at the Asian index. We've got the same story. The Asian index against the US dollar. And again, you know, it's on this precipice and looks like it's heading a lot lower. Now, that basically tells you that 20%, the Asian currencies have declined by 20%, which is a massive decline, you know, and right on this precipice and looking to go further. And basically what it means is for every Asian currency, you know, every dollar of Asian currency, it's going to cost them more against the US dollar, okay? And that basically thumps growth in those Asian economies. It really makes growth even worse, particularly if they have debt and they've got to pay it back in US dollars, then they're even in more trouble because they have to pay back more debt against US dollars and with less of their own currency. And it really makes it pretty bad for them because it means that they're paying back a lot more in terms of their own GDP and what they're able to actually earn in receipts, which is not great. If we look at the JP Morgan's Emerging Market Currency Index, it's also looking pretty bad as well. You know, again, Emerging Market Currency Index, and again, these are all relative to the US dollar on its all-time lows, okay, even back in 2011. And not a great story, okay, not a great story. And this is pretty much what I alluded to when we talk about emerging market currencies. You know, we're talking about Venezuela, we're talking about, you know, Venezuela, Argentina, we're talking about Brazil, you know, all those different emerging market currency, emerging markets that basically are seen as, you know, third rate, okay? So what we've got as a relative trade, we've got US dollar strengthening against all the emerging market and Asian currencies. So we've got a global problem here, a global problem which is going to really crump growth globally, okay? And that's scary. Now, also what we've been seeing is buying Bitcoin, gold, and obviously bonds and the interest rate curve. And we have seen just in the past that Bitcoin is becoming increasingly, according to this article, non-correlated with traditional markets. Now, what that means is, and we'll go through that, is if traditional markets go down, Bitcoin is going up. If traditional markets, say, for example, the equity market is going up, Bitcoin is going down. If currency is going down, say the Chinese renminbi, which it was and has against the US dollar, Bitcoin is going up because the Chinese are getting out of their own currency where they're going to lose their own wealth and they're going to buy Bitcoin as a safe haven. And that makes sense, doesn't it, right? Because why would you sit in your own currency when it's getting devalued and going lower and lower and lower? You might as well get out of your own currency, sell your own currency on the crypto exchange and buy Bitcoin or XRP as a store of wealth. And that's pretty much what we're seeing in countries, as I said yesterday, in countries where the currency is going lower and lower. It's devaluing. We saw it in Turkey. We saw it in, emerging markets like Venezuela. We saw it in Puerto Rico. We've seen it. We've seen it in Venezuela, Argentina. We've even seen it in Kenya. We've seen it in other parts of Africa as well. Okay, even in South Africa. So it's really a big story. This. Now, this is when we come up to this correlation. And basically, correlation is just the movement between two different asset classes, how they move against each other. For example, if you've got a portfolio, you really want to be you really want to have a portfolio where one of your assets, if the market gets more and more volatile, you don't want all your assets to go up or down. So you'd like all your assets to go up, I should say. But if the markets get volatile and they start selling off, you'd like some assets to show a positive return and some assets to show a negative return. In other words, you have a hedge. So where you're losing on one, you're making on the other, okay? Now, correlation, basically, Bitcoin is 100% correlated to itself because you basically, Bitcoin against Bitcoin, the movement is 1 for 1. So obviously a positive correlation, right? Bitcoin moves against itself 1 for 1. Okay, so if we go across this, and the way to read this is, if Bitcoin goes up $1, Bitcoin goes up $1, so does Bitcoin. If Bitcoin goes up $1, Ethereum only goes up by 83 cents to Bitcoin of $1, okay? If Bitcoin goes up $1, Litecoin is only going up by 66 cents with the Bitcoin move of $1, okay? If we go to S&P, Bitcoin goes up $1, the S&P goes down. That's a negative relationship, okay? So it's a hedge. If the S&P is coming down, people are buying Bitcoin as a hedge against the S&P going down, which is equities. So the more equities go down, people are starting to buy Bitcoin to preserve their wealth, okay? Now, if the equities go down, gold's going up. And that's what we're seeing the last 30 days of correlation according to this table, if this table's right. Okay, so in other words, equities are going down and people are buying gold as a safe haven and they're buying Bitcoin. So Bitcoin and gold both have a positive correlation against each other. In other words, if Bitcoin's going up, gold's going up at the moment for a 30-day correlation. Now, correlations change over time. This could be, we could look at a year out, or we could have looked at 60 days ago or 90 days, and it could have been a completely different correlation. Correlation changes every day, every second, every day, right? So the same story. If we look at Ethereum against Bitcoin, Bitcoin, again, $1 move by Bitcoin, Ethereum's only moving up by that. Ethereum against itself is moving one by one. You know what I'm saying? So it's just that simple, right? So again, if we look at S&P against the other cryptocurrencies, all negative. S&P is negative against the other cryptocurrencies, negative correlation to the other cryptocurrencies, which is positive. And then against gold, if you go back to the S&P, 1 for 1 to the S&P, and then against gold, also a negative relationship. Okay, so we're seeing cryptocurrency and gold behaving the same. Okay, and gold's got a positive relationship between all the other cryptocurrencies except the S&P. Now, I will show the other correlation against XRP as well, so just bear with me. So what people are doing, yes, they're buying Bitcoin, and we have seen that out of China, certainly. Now, again, you know, this writer basically looks at, you know, also the Indian Reserve Bank slashing rates by 35 basis points. This is a spread against Bitcoin, which is, to me, is a silly chart to do, really, because it's looking at the interest rate of the Reserve Bank, and it's spreading it against Bitcoin, which, you know, yes, it's a part, you know, basically Bitcoin's going up and over the cut by the Indian Reserve Bank. So it's not really, it's only telling me that Bitcoin's outperforming the Reserve Bank Indian rate. Okay, so, you know, whether that's, you know, feasible spread or not, I don't think it is. But look, it just tells you that it's a positive. Bitcoin's actually outperforming the Reserve Bank of Indian's cash rate. Okay, so also what it's saying is Bitcoin can provide asymmetric returns, and so in other words, the payoff, you know, can be a lot higher than the downside, and that's pretty much, you know, what some of these people in the financial markets are actually saying. So this Popliano, who is basically Morgan Creek Digital, whoever this guy is saying, yes, we're seeing, you know, with the Chinese devaluation, Bitcoin was rising, and that's fine. We have seen that. And Bitcoin's becoming increasingly correlated to gold just in the last 30 days or so. So interesting story, I thought, very interesting story. So if we go to correlation and, you know, check this out, Coinmetrics correlation. And, you know, I want to look at, say, the last 30 days. Now, I've got a lot of correlation up here. But what I'll do is I'm going to take all these down so you can see quite clearly, okay? So let's go in there. And let's go for the last month, and we'll look at XRP and gold, okay, for the last month, okay. So basically, the way to read this is from the 10th of July to the 7th of August, and that correlation back on the 10th of July was 0.14, okay. So there's a positive relationship between XRP and gold. If gold went up, XRP would go up by 0.14, okay. Now, as time's gone on, this correlation's come down to 0.04, it's gone back up to 0.11, and it's come down to 0.08. But what this is basically saying is there's a positive relationship between XRP and gold, okay, at the moment of 0.0873. If we put Bitcoin in here rather than XRP, just to compare both, basically, just looking at both, it's basically saying with Bitcoin, it was around, 17, and it's still currently at, you know, 13. So pretty much the same story as XRP, a positive relationship, okay? So XRP has got the same relationship as Bitcoin to gold. If gold goes up, Bitcoin goes up, XRP goes up. Gold goes down the last 30 days, the same story. XRP goes down and Bitcoin goes down. So if we look at Bitcoin and the stock market, and we'll use the S&P, for example, only over 30 days, we'll find this story. So to the stock market, in the last 30 days, it was zero, then it was positive, and now it's come to negative, okay? So in the last 30 days, we've seen Bitcoin has a negative relationship to the stock market of around, negative 0.08, okay? So in other words, if the stock market goes up by 8 points, Bitcoin goes down by 8 points. It's a negative relationship. In other words, if Bitcoin goes up, the stock market goes down. If the stock market goes down, Bitcoin goes up. A negative relationship to the stock market. And that's seen as a hedge if you have a portfolio. All right, it's all a relative value trade, and that's what we call relative value. So if we compare XRP to the S&P, XRP is the purple one. Again, 30 days ago, we had pretty much, about 0.06, and then we've seen this come down as not a negative relationship, but it's still a positive relationship. That's very interesting. Whereas Bitcoin has actually got a negative relationship. Okay, so this is basically saying XRP has still got a positive relationship to the stock market, but it's not as positive as it was. Okay, so it was around, 0.06, and now it's 0.04. So in other words, if the stock market goes down by 0.04, XRP is going to go down by 0.04. But it is, that correlation is reducing. That's quite interesting, very interesting indeed. Okay, so we look at Bitcoin and we look at it against, say, currencies. Okay, so we use the DXY, which is the currency basket for the US. So let's just see how Bitcoin is behaving against the currency basket of the US in the last 30 days. Let's add that. So what do we got here? We've got Bitcoin. It was negative around, what's that, about 0.07. And we're still seeing a negative about 0.08. So in other words, if the currency basket of US dollar goes down, there's a negative relationship with Bitcoin. So in other words, if the US dollar is going down, Bitcoin is going up, or vice versa. Make sense? So let's have a look at XRP on this. And just for 30 days, just to have a look at that. So let's look at XRP. What's this telling us? A very similar story. Okay, negative correlation. Negative correlation. So if the US currency against its own trade-weighted basket, against all of the other trade-weighted currencies like the renminbi and whoever it trades with, is going down, XRP has a negative relationship to that. In other words, XRP will go up. Only small, but it will go up, and it's very similar to the Bitcoin story. Okay, so that's very interesting. So let's have a look at something else here. If we look at Bitcoin and we look at it against, what else we got here? So we looked at gold, we've looked at the currency basket, we looked at the equity market, and we look at volatility, okay, which is also, VIX is used in the equity market. As volatility rises and rises and rises, you generally get the equity market coming off when volatility rises. Let's check that out for 30 days. So if we look at Bitcoin, that Bitcoin there, and the VIX, we have seen over time, make sure we've got the right one here, it was negative, and what have we got now? And then it became positive. That's very interesting. Okay, so over the 30 days, Bitcoin was negative to the VIX, and now it's become positive. So in other words, as the volatility, the VIX, which is the volatility measure for the S&P 500, as that volatility measure gets higher and higher, and that will get higher and higher with the stock market coming down, there's now a positive relationship between Bitcoin and volatility. So the higher the volatility, the higher Bitcoin will go. Okay, if the VIX goes down, stock market goes up. Stock market goes up, Bitcoin goes down. VIX goes down, stock market goes up, Bitcoin goes down. If volatility goes up, stock market comes down, Bitcoin goes up. Very interesting indeed. I like looking at these measures, I have to say. I find it very interesting. So let's check out XRP on this. If you're bored, please leave. Please go. Because I really love charts. I really love looking at this stuff. It fascinates me. Always has, actually. I don't know why. I just love it. If we look at VIX and the XRP, we find that there was a negative relationship. So in other words, as the volatility of the VIX got higher and higher, XRP would go lower and lower, negative relationship. And interestingly enough, we are still seeing a negative relationship. That's very interesting. So what I conclude from this is, in my mind, XRP will start behaving very soon, very much like Bitcoin, because I do believe that as fiat markets start to implode and start to go down quite dramatically, devalue, i.e. the equity market goes down quite dramatically, and bond yields go down, to all-time lows, and also we find that fiat currency is moving down. What I do believe is we'll see XRP's correlation changing, rather than being, positive when the currency market or the fiat market's going down, which means XRP would go down. you'll find that relationship, in my mind, changing, and we're starting to see it within these correlation curves just over the last 30 days. XRP will become negative. So in other words, equity market down, Bitcoin up, XRP up. Now that's what we've got at the moment. We've got Bitcoin up and we've got Bitcoin up and equity market down. Okay. At the moment, we've got Bitcoin up, volatility up, and equity market down. XRP, in my mind, should start behaving very similar to Bitcoin. It's a much more secure store of wealth as far as I'm concerned. It's less volatile than Bitcoin, and obviously you can cash settle instantly. So I will keep an eye on those correlations very, very closely, because it shows a very, very interesting story as far as I'm concerned. Just very quickly, and like everything, gosh, when I start yapping, I tell you, time just goes, man. It's just unbelievable. Just wanted to show you something else. This came out from Grayscale Insights by a guy called Matthew Beck, just recently released, and I think it's a really interesting article. I look at these guys, I find their stuff quite interesting, a real-time case study. They're looking at hedging US-China trade risk with Bitcoin. Really very, very interesting study. They're talking about a financial crisis. They're saying that we've seen many financial crises, and we have, where there's been massive, large equity drawdowns just very quickly. And what that means is, yes, the equity market has literally fallen off a cliff, and there's been absolute wealth destruction, okay? And people have just got out of equities, just literally sold out their equities. And we're seeing that also with, as I mentioned yesterday, Fidelity, which is one of the biggest, largest fund managers in the world. They've got over 2 trillion funds under management, right? So, there was the oil crisis, a massive drawdown of 80%. We had the GFC, the drawdown was 60%. But again, you got to remember, in these crises, there was a lot of stocks that actually went to zero, okay? So it could have even been worse. You had the Russian default thing. You had long-term capital management that lost all their money. It was a hedge fund run by academics. I remember it well. In 97, 98. You also had around this time the Asian crisis with credit spreads. I remember that very well. And this massive drawdown, is coming again. And as this article says, we only see in equity markets, we see an equity market bull for about 10 years. And pretty much that's what we've got now. And then we see a massive drawdown. It does talk about liquidity risk, which is what I've talked about, that liquidity risk is getting worse. In other words, the risk is rising. There's a lack of liquidity. It has been controlled by federal governments and central banks, but it's been mismanaged, and I agree with that totally. You don't have the players in the market, in the financial markets, we used to have in the past, to offset risk, like the prop traders and the speculative traders and the big traders, to take the opposite side. And what it's also saying in this article, that there's more debt out there in the real world than liquidity can manage. So in other words, there's a huge amount of debt, and liquidity in the market can't offset that debt. And that's a really, really scary thing. Okay, very, very scary indeed. And that's what I also said yesterday. There's no one to take the opposite side of these risk trades in this market anymore. And that's why markets run the risk of gapping down quite dramatically. It talks about a key component of liquidity risk is that there's a lot of leverage in the financial system. And basically they're talking about global debt is roughly 250 trillion. It's massive. And debt to GDP is over 300%. Now what that means is, to put it in layman speak, right? Debt to GDP, gross domestic product, okay? So it's like me as an individual. Let's put this in layman talk. This is according to a balance sheet of a country. But let me put this in layman speak. If I have a wage of $100, right, and my GDP, right, my wage is $100, which is my GDP, okay? In other words, that's what I'm producing. Me as a balance sheet, my wage of $100, which is my GDP. So it's equivalent to my GDP, which is what I'm producing, my revenue. But my debt is 300 to my wage of 100. So in other words, my credit card is 300% my wage of 100. This is exactly what this is saying. So in other words, I'm earning $100, but I have to pay out 300. debt every time I earn $100. This is what this is effectively saying, that the economies in the world basically have so much debt against their gross domestic product. In other words, they cannot sell enough product to get revenue in the door to pay down the debt, that, you know, there's countries that are literally drowning in debt. And the risk is, if interest rates go up, they are not going to be even able to pay back the interest, let alone the capital on the debt. And that is a very, very scary thought. And what this article is saying is there's not enough liquidity in the system, enough money in the system to offset this huge amount of global debt. And that's a very, very scary thing. And thus it says the looming risk of a liquidity crisis is also high. Now, we saw that in 08, 09. There was literally, the liquidity risk was huge. In other words, when there's no liquidity in markets, markets can literally fall within a second. I mean, I also saw it in August 2016 when the Swissy was unpegged. The Swiss dollar was unpegged against the euro, and the Dow literally moved down 1,000 points within a second. And that's a lack of liquidity that I'm talking about. When the market moves down so quickly because there is no liquidity and no players in the market to take the opposite position of all the sell orders coming on, okay? So what happens is you get triggered on stop losses wherever it hits on the buy side on the way down. And don't forget, stop losses are not guaranteed unless you pay a premium for a guaranteed stop loss, okay? They're not guaranteed. People think that just because you've got a stop loss in place, it's guaranteed. It's not. A stop loss will get done wherever the market finishes. You know, even if you've got, say, a stop loss at 20, the market doesn't trade there, you're not going to get done there. The market trades at 13, you're going to be done at 13 no matter what. The only way you can get done at a stop loss of 20 is you've got to have a guaranteed stop loss. Okay, guarantee where you pay a premium for it. That's the only way, because that means you get done there even if the market didn't trade there. So be careful, guys. Be careful, particularly on currency side as well as anything else, all right? Crypto, whatever. I think in crypto markets they don't have guaranteed stop losses, but certainly in the foreign currency market they do, and certainly in the bond market, in the capital markets, you can have guaranteed stop losses, okay? So, yeah, read this article. Very, very interesting. Sorry, guys, I always go too long. I know I get yapping and I can't help myself. Look, please do look after yourself. Be kind to yourself. Be kind to your family and friends. Be kind to your putty cats. Be kind to your dogs. Be kind to all the animals in the world. Please do look after yourself. Be kind to people in the world. Just make this place a better place. There's so many horrible, horrible people out there. And I just want to live a good, happy life. Seriously, life is short. Life, you know, there's no time for anything. Life goes fast, man. And, you know, people die. Animals die every day. And I miss my animals every day. And I miss people out of my life that aren't here anymore. So I cannot understand why some people are just so horrible and so cruel. Anyway, guys, please look after yourself. And I hope you find this very interesting. Cheers, Susie. Thank you.